Have you ever wondered if the father of modern physics, the man who gave us the laws of motion and gravity, would have been a long-term hodler? The idea seems almost ridiculous, doesn't it? Isaac Newton, the ultimate man of reason and logic, sitting on his hands while the market goes through wild swings. But what if we're looking at it all wrong? What if the principles that guided his scientific breakthroughs, the same ones that shaped our understanding of the universe, are the very same principles that could make him the perfect long-term investor? Building context. Today, we're diving deep into the mind of a genius to explore a truly fascinating question: what would a Newton-esque approach to hodling look like? This isn't just about applying a few famous quotes to a crypto chart. This is about deconstructing his fundamental worldview, his scientific method, and his personal experiences to build a comprehensive investment philosophy. We'll examine three key areas: his laws of motion, his unwavering belief in universal principles, and his infamous, and ultimately costly, personal foray into the world of finance. By the end of this video, you'll have a new perspective on hodling, one that is not just about patience, but about a deep, almost scientific, understanding of why you are holding. Main content, Part 1, The Laws of Motion and Market Inertia. Let's start with the most obvious and powerful connection, Newton's first law of motion. An object in motion stays in motion with the same speed and in the same direction unless acted upon by an unbalanced force. Now, let's translate that into the world of cryptocurrency. Your investment, once made, is an object in motion. It has a direction and a speed, whether that's up, down, or sideways. The unbalanced force is the external pressure that makes you want to sell. It could be a sudden price drop, a FUD-filled news article, or the emotional turmoil of watching everyone else get rich faster than you. A Newton-like hodler would understand this inertia. They wouldn't see a price drop as a reason to panic, but as a test of the underlying forces at play. They would ask, has the fundamental thesis of this project changed? Is the team still building? Is the community still active? Or is this just a temporary, emotional force acting on the market? Newton understood that objects don't just randomly change their trajectory. There is always a cause. Similarly, a true hodler would seek the cause of market movements, rather than just reacting to the effect. They would differentiate between a minor gravitational pull and a major, planet-altering collision. They would understand that small, emotional forces shouldn't be enough to knock a well-chosen asset off its long-term trajectory. Then there's the second law: force equals mass times acceleration. F equals ma. Think of force as the total buying and selling pressure in the market. Mass is the total market capitalization of a coin. Acceleration is the rate of change of its price. What does this tell us? It tells us that it takes a much, much larger force to move a massive coin like Bitcoin than it does to move a tiny, low-cap altcoin. A Newton-like hodler would grasp this intuitively. They would understand that the volatility of a small cap is not a sign of its inherent worth, but a direct consequence of its low mass. They would also understand that a massive, well-established coin's slower movements are a sign of its stability and resilience. They wouldn't be swayed by the rapid, but often short-lived, parabolic moves of smaller coins, because they would know that those movements are the result of relatively small forces. This understanding provides a solid foundation for risk management and portfolio construction. And finally, the third law: for every action, there is an equal and opposite reaction. This is the law of market cycles. Every bull run is followed by a bear market. Every period of exuberant buying will eventually lead to a period of selling. A Newton-like investor wouldn't be surprised by this. In fact, they would expect it. They would view a bull market not as an endless party, but as an action that will inevitably trigger an equal and opposite reaction. They would use this knowledge to prepare, not to panic. They would see a bear market not as a catastrophe, but as the natural and necessary reaction to the previous euphoria. This perspective removes the emotion from the equation, replacing it with a cold, hard, scientific understanding of market mechanics. Main content, Part 2, The Search for Universal Principles. Beyond the laws of motion, Newton's entire life was a quest to discover universal, unchanging principles that governed the cosmos. He wasn't interested in the day-to-day fluctuations of planetary orbits, but in the underlying law of gravity that made them all predictable. A Newton-like hodler would apply this same philosophy to their investments. They wouldn't be focused on the daily price chart, but on the fundamental, universal principles of a project. What are these universal principles in crypto? They are the core ideas that a project is built on. Is it truly decentralized? Does it solve a real-world problem? Is the code open source and immutable? Is the community aligned with the long-term vision? A Newton-like investor would spend countless hours in the library, not the trading floor, researching these principles. They would be less concerned with hype and more concerned with the foundational logic of a project. They would ask, does this project have a gravitational pull? Is it attracting developers, users, and capital because of its inherent value, or is it just a fleeting trend? This mindset requires a level of detachment from the emotional roller coaster of the market. It requires a belief that if the universal principles are sound, the short-term noise is irrelevant. It's the difference between being a meteorologist who focuses on today's weather and an astrophysicist who studies the fundamental forces of the universe. The meteorologist can tell you if it's going to rain tomorrow. The astrophysicist can tell you why stars exist in the first place. A Newton-like hodler would be the latter, confident that if a project has the right universal principles, its long-term success is a matter of scientific certainty, not market sentiment. Main content, Part 3, the South Sea Bubble and the Limits of Reason. Now, for the most fascinating and humbling part of this analysis. Isaac Newton, the man who brought order to the cosmos, was a victim of one of the greatest financial bubbles in history, the South Sea Bubble of 1720. He invested early, made a significant profit, and then, believing he was too smart to get caught in the madness, pulled his money out. He watched as his friends made fortunes, and then, blinded by greed and the infectious optimism of the crowd, he re-entered the market at the absolute peak. He lost a staggering amount of money, an amount so large that he famously declared, "I can calculate the motion of heavenly bodies, but not the madness of people." With that said, thanks for watching and until next time.